If you've ever sold something online and thought, please don't make this a tax headache, this is the part nobody explains clearly. A Form 1099-K is not a tax bill. It's a receipt the system uses to compare what you file against what platforms processed. And the whiplash lately is that the rule for when platforms have to send that form has changed, been delayed, and then changed again. Here's what matters right now, in plain terms. The Internal Revenue Service says payment apps and online marketplaces generally have to issue a Form 1099-K when payments for goods or services are over $20,000 and more than 200 transactions for the year. Some platforms can still send forms at lower amounts, and mistakes happen. The form is an information return. The taxable part is still the income you actually earned after you separate personal transfers and after you account for costs when you're selling at a profit. By the end of this video, you'll be able to do 3 things. 1, tell the difference between I got a form and I owe tax on that whole number. 2, reconcile that form to your real profit with a simple method. And 3, know exactly what to check so you don't overpay or underreport by accident. Picture a common scenario. Someone sells used baby clothes and an old stroller online, mostly just cleaning out the house. Over the year, they also use a payment app to split rent and utilities with a roommate. Same app. 2 totally different types of money. If a form shows up, the first question is not, how do I pay this? The first question is, what does this number actually include? Because the basic trap with Form 1099-K is that it reports gross payments processed. Gross is before platform fees, before shipping labels, before refunds, before chargebacks, and before you separate business payments from personal reimbursements. That's the mechanism. Platforms see flows. Taxes care about income. So here's the clean chain from click to tax outcome. A buyer pays through a platform. The platform processes that payment. At year end, the platform may issue a Form 1099-K showing the gross amount of payments they processed for you for goods or services. Then you, the taxpayer, still have to classify what that money was, subtract what wasn't income, and calculate the taxable part. That is why 2 people can both have a $10,000 Form 1099-K and have totally different tax outcomes. One person sold personal items at a loss and kept records. Another person ran a side business with costs. Another person had a form that accidentally included reimbursements. Now let's make it concrete with a fast number example. Say the baby clothes seller had $7,000 of payments processed for sales over the year. The platform charged about 10% in selling fees on average, plus they spent about $800 on shipping labels. They also issued $600 of refunds. The Form 1099-K might still show $7,000 because it's gross payments, but the seller's real proceeds could be closer to $7,000 minus fees, minus shipping, minus refunds. That's already a couple $1,000s different from what the form shows. And then there's the bigger question. Were those sales taxable income at all? If you're selling personal items for less than you paid, that is usually not taxable income. It can still be reportable on a form because the platform doesn't know your original cost. That's why records matter. Your taxable result depends on profit, not just cash flow. On the other hand, if you're consistently selling at a profit, or you bought inventory to resell, that starts to look like business activity. Same platform, different tax category, different paperwork expectations. That's the part people miss. The form is a flashlight. It shines on money movement. It does not label what the money meant. So the practical goal is not to panic about the threshold. The practical goal is to be able to reconcile whatever you receive. Here's the one screen that usually answers half the confusion. It's the platform's annual summary or downloadable transaction ledger. You're looking for a report that shows, line by line, the sale amount, date, fees, shipping, refunds, and any chargebacks. If the platform offers an amount reported on Form 1099-K figure, pull that too. Then you do a quick reconciliation in 2 passes. Pass 1 is the gross to net pass. Start with the gross payments number, subtract platform fees, subtract shipping you paid, subtract refunds and chargebacks. What you're left with is the money that actually reached you before you even talk about whether it was profit. Pass 2 is the tax category pass, separate money that was for goods or services from personal transfers. Then separate personal item sales from business-like sales. Then, for anything that was business-like, line up the costs. If you only do one thing, do this. Do not treat gross payments as profit. That is how people overpay. Now, let's go back to the scenario and stress test it. Our seller has roommate reimbursements mixed in. Those reimbursements are not payments for goods or services, but apps and users sometimes mistag transactions. So, one practical risk is mislabeling. If the roommate accidentally marked rent reimbursement as for goods and services, that could inflate the gross number that looks reportable. And it can also create a mismatch in your own records, where deposits don't line up with what you think you earned. So the check is simple. In your payment app, look for the setting or receipt that shows whether a payment was tagged as goods and services versus a personal transfer. Then scan your history for anything that looks like reimbursement but was tagged the other way. That's not tax planning, that's just cleaning up labeling, so your records match reality. Now, a quick counterpoint, because not everyone will see this the same way. Another reason a Form 1099-K can look weird is timing. Some platforms show payments when the buyer paid. Some show it when the transaction settled. Refunds can be processed later, so you can do everything right and still see small mismatches. So, the practical way to frame it is, you're not trying to make the form perfect. You're trying to make your reporting consistent with your records. So, what does the rule change really change in your actual life? It changes how often people get surprised by a form. It doesn't change what's taxable. A higher threshold can mean fewer casual sellers get a form in the mail. But here's the non-obvious part. That can actually increase mistakes because people think no form means no reporting. That's not how taxes work. Income can be taxable even without a 1099-K. And the opposite is also true. A 1099-K can show up even when the taxable income is zero, like when you sold personal items at a loss. So instead of focusing on, will I get a form, focus on 3 signals that tell you whether you need to tighten your records. Signal 1. Your platform starts describing you as a seller with an annual summary and payout statements. That's your cue that your activity is being tracked in a business-like way. Where to look? The platform's year-end tax center or annual summary page. What direction matters? If it shows gross payments for goods and services, you treat that as a reconciliation target. Timing. You usually see these summaries after year-end and before filing season ramps up. Signal 2. Your account shows frequent refunds, chargebacks, or fees that are meaningful compared to your sales. Where to look? The transaction ledger and the fees, refunds sections. What direction matters? If refunds and fees are a big slice, gross numbers will be misleading, and you need clean net numbers. Timing. This is visible all year, and it compounds fast if you wait until January. Signal 3. You're mixing personal reimbursements with sales inside the same app, especially if you ever use goods and services settings for personal payments. Where to look? Payment tags in your app history and your bank deposit descriptions. What direction matters? If reimbursements are tagged as sales, your records will be messy and could inflate reported totals. Timing. This is a real-time fix. The sooner you correct labeling habits, the less cleanup later. Now, decision rules, because people ask the same question in a few different ways. If you're mostly a casual seller cleaning out your house, the main job is proving what was personal and what you paid originally, at least in reasonable ranges. Receipts are great, but if you don't have them, even a consistent method helps, like saved listings, screenshots, or a simple log of what you sold and why it wasn't profit. If you're doing this like a side business, the main job is tracking profit, not deposits. That means separating fees, shipping, returns, and cost of goods sold as you go. And if you're mixed, casual plus business-like, your job is separating buckets. One account for sales, one for reimbursements. Or at minimum, one spreadsheet that tags every inflow. Now, your 2-minute checklist. This is the stop guessing version. 1. Pull the platform annual summary or transaction ledger and find the number labeled as the amount reported, if it exists. 2. Compare gross payments to actual payouts after fees, shipping, and refunds, so you understand the gap. 3. Scan your app history for personal reimbursements tagged as goods and services and fix that going forward. 4. Make a simple list of personal items you sold and what you roughly paid, so you can explain why it was not profit. 5. If you resell for profit, separate your costs because gross is not income. If you do those 5 checks, Form 1099-K stops being scary. It becomes what it really is, a paperwork signal that tells you to reconcile, not panic. If this helped, subscribe to the Wealth Blueprint for more clear money breakdowns. And leave a comment with the next topic you want covered, or the one part of today's video you want explained even simpler.